Good morning. Welcome to the Genghis Weekly Investor Briefing. My name is Daniel Ogeto from the Marketing Department, and together with our Research Department, we bring you to this webinar to enable you get to know what happened in the past week in the financial sector and what to expect in this coming week. Now, with us today is Wesley Manambo and Melody Ndanu taking us through the presentation today. And being a new quarter, we are waiting to see what they have in store for us. So over to you, Wesley.
Good morning, Daniel. So I'll be sharing the screen, if that's okay. So has it come up?
Yes, it has. Just put it on full screen.
Okay, good morning, everyone. Thank you for setting aside some time to join us today. So I'll start by looking at the macroeconomic reviews and the fixed income segments. Then my colleague Wesley will take us through the equities, and I'll go through the financial sector highlights. So just to start, last week, the inflation numbers came out. And in September, it edged up to 6.91% year-on-year from 6.57 in August. So this is the fourth month that there's been a consecutive upward inflationary pressure. And this has mainly been attributed to the double-digit growth in fuel costs, mostly pushed up by the latest review by EPRA and also the removal of the stabilization fund. So also we've seen that due to the increasing crude oil prices and as well as the tight supply, we're going to see some more price increase, unfortunately. Food inflation, it hit 10.6% year-on-year, with prices expected to continue going upwards, mostly because of the drought conditions that we're seeing going on at the moment, as well as supply chain constraints. So also on LPG gases, the price of butane and propane, these are the byproducts that are usually used to manufacture LPG, have been going up in the recent months, and mostly due to increased demand and low supply from the Gulf countries, which are the main source of LPG gas for Kenya. So it's expected that this price increase will be felt in the coming months. And then also remember that VAT was introduced on LPG just recently. So it might end up causing a pinch to the pocket for Kenyans as the prices go up. So mainly the supply has been going down due to outages as well as scheduled maintenance. So on a positive note, however, just recently, the government has reported that it's planning to introduce price controls for cooking gas. So they want to complete an oil terminal at Kipevu called Kipevu Terminal, and this is where it's supposed to give a common user berth for handling the fuel. So it's supposed to be, this facility is supposed to be completed in December. So maybe we might see some progress after that. And on electricity costs as well, we've seen that it's been going up. However, we saw that the task force that had been appointed by the president to look into KPLC, they came up with certain recommendations. And so Kenyans can be anticipating a 33% reduction in electricity tariffs starting from December. So that means that the reduction of tariffs will be from 24 shillings per kilowatt to 16 shillings per kilowatt. So hopefully this will come into effect and it will ease the burden of cost of living. As we look at another set of news was that the CBK Monetary Policy Committee, they retained the CBR rate, that's the central bank rate, at 7%, which is the 10th consecutive retention. So they noted in the press release that the inflation has been in the target band, which is 2.5 to 7.5%. though they expect inflationary pressures to continue in the near term, as we've seen due to the increase in oil prices and just increased demand, weakening of the shilling. But the core inflation, which now looks at demand, it's within the target range, and it's going to be muted. Yes. So looking at the external sector with imports and exports. So imports have been growing 11.5% year on year, but inflation has been much higher at 22.9%. But the government is expecting that to go down to 5.2%. So looking at credit to the private sector, they noted that it grew by 7% for the 12 months ending August, up from 6.1%, as they noted that loan applications were picking up. However, we see this is still like the private sector growth is still lagging behind. And we've also noted, because now banks still haven't gotten approval for the risk-based pricing models, of which is an open-ended request, we might see that banks still continue to use conservative lending policies. Another piece of news is that the High Court last week temporarily halted the planned annual inflation tax adjustments, and this could have seen now an increase again in fuel prices and also other goods like alcohol as well. So this proposal was supposed to be approved by the Treasury before it was effected. However, this High Court's ruling came in before that. So this approval is the first time that actually KRA needs to get approval from Treasury before it implements this. So this can give Kenyans a sigh of relief, at least to temporarily ward off the high fuel costs. But as we said earlier, this is unfortunately short-lived, because we've seen like the price of crude oil going up to about $80. So these are new highs due to constraints. Also, there was the realization that funds from the petroleum development levy are also almost depleted, and this is what was being used to stabilize the fuel prices. And also of note, this levy fund did not have a legal framework per se, so there was some opaqueness to how the fund was being run. So looking at now this temporary hold on the annual excise duty inflation change, as well as the High Court ruling on minimum tax, we're going to see the government having a budget deficit of about 21 billion. That's mainly due to the minimum tax. So we're going to see the government either trying to look for alternative ways to filling in the gap. That's either expanding the tax base or increasing taxes, because they still have the requirements they were given for the IMF program, where they're supposed to raise government revenue. So we're going to see how that plays out. Also, there's an issue of the omission of fuel. There's this levy, the 5 shillings and 40 cents charged on diesel, that has been noted that it's being consumed in the country without backing of the law. However, now a report recommended by the National Assembly, they said instead of, it's something that can easily be corrected through a gazette notice. So we're going to see how that plays out. So looking at fixed income, the fixed income sector, or other segments, so market activity fell by about 42% week on week to 23.1 billion, with interest mainly towards the infrastructure bonds, as we've seen over the last few weeks, as well as on the longer segment of the yield curve. So we are of the opinion that mainly trades fizzled out because investors were focusing on positioning on themselves on this triple tranche issues that are supposed to be going on auction this week, actually on 6th. So, and also there's been some tight liquidity, so that could be a factor as well. So looking at the CBK's choice for, or rather the government's choice for longer tenor papers, it comes into their policy of lengthening the domestic debt duration. So looking at T-bills, they fell marginally for the third consecutive week with an overall performance of 44.2%. It's down from 42.33 the previous week. And we've seen interest mainly has been going to the secondary bond market. So yields have been going up 0.419% year on year on average, or rather year to date across all tenors. And the 91-day T-bill rate has actually been edging upwards. It's going close to the 7% base rate for the Apex Bank. Looking at liquidity trends, so the interbank markets showed tightened liquidity. So the average interbank rate actually went up to 6.71%, a 57 basis points jump from the previous week. So the Apex Bank has been mostly towards this end of the month, or rather towards last week, it was mopping up Kenya shillings from the market using term auction deposits. So they were seeking to mop up 30 billion, but received bids of up to 28.2 billion. Of this amount, CBK accepted 18.2 billion at 6.89%. So we've also noticed that the CBK's foreign reserves have been dropping, and it could be assumed that this is due to the CBK releasing dollars to ease the pressure on the shilling from further weakening. Also, we saw that there was the notice that they were going to pay 5.5 billion shillings to the Treasury. So that could also have an effect on reserves as well. Looking at government lending, it's estimated at 267.4 billion. That's about 40.6% of the targets. Looking at the macroeconomic calendar, so on 5th, we expect the purchasing managers index for September. So the previous one was 51.1. So anything above 50 shows optimism, and anything below 50 shows some pessimism about the market. On 6th, as I mentioned, they have the triple bonds that are being reopened. That's when the bond auction is due to take place. So just looking at the ranges for the three bonds. So for the FXD1 2013-15, it has a lower range of 11.9 and upper for 12.05. For FXD3 2019-15, that's 12.9 to 13.1. And FXD1 2021-25 is 13.7 to 13.85. So, as we said before, we've seen that the tenors are long, like 12.9 years and 24.7, except with the exception of the 6.4 years, of which maybe the government has included this one to include investors who are interested in the shorter end of the yield curve. So actually, the weighted average life of the FXD series has gone up to 8.9 last month as compared to 8.83 in the previous month. That just goes to show that the government is still, it's in line with their 2021 medium-term debt management strategy. So the 60 billion shilling reopening has been earmarked for budgetary support. And we note that there's an IFB 2009-12 that's maturing on the 22nd of November. And that outstanding amount is about 5.4 billion. So part of the proceeds may be used to retire this bond. And of note is that in Q4, there are no bonds maturing. So it could be that this bond is mainly just for budgetary support. So the coupon payment dates for the bonds, so it's 14th of February 2022 for FXD1 2013-15, 24th of January 2022 for FXD3 2019-15, and 8th of November 2021 for FXD1 2021-25. So investors would have to look at this accrued interest that would have to be paid to the person who's selling the bonds so that they can actually acquire these bonds. So they'll have to add it to the clean price to get the dirty price. So according to the bond prospectus, in terms of taxation, the three bonds are subject to a withholding tax rate of 10%. So I'll hand it over to Wesley to take us through the equities.
Thank you, Melody. Good morning to you. The market closed the week at a cautious tone with the key indices diverging. The Nairobi All-Share Index peaked 1.9% week on week to settle at 181.23 points, while the NSE 20 Share Index shed 10 basis points on a week-on-week comparison to close at 2038.08 points. That said, activity dropped 49.6% week-on-week to a turnover of 1.62 billion. Eagles led the pack of the week's top gainers on a 6.9% week-on-week rally. Olympia, Everready, Samia, and Serena gained 6.4%, 5.2%, 4.9%, and 4.2% week-on-week respectively. TransCentury led the week's laggards, shedding 8.6%. Scan Group, BOC, NMG, and Express shed 5.1%, 4.2%, 1.5%, and 1.4% week-on-week respectively. As a side note, Scan Group's performance in the week was significantly driven by a profit warning they issued in their half-year results, which in my opinion was quite commendable from the continued business point of view. The profit warning projects the current financial year's net consolidated earnings to fall by at least 25% as an adjustment to last year's gains from discontinued operation. Last year, we saw the company discontinue operations in Millward Browns East Africa, Millward Browns Nigeria and West Africa, and Research and Marketing Group Investment Limited for around about 2.3 billion. And looking at BOC, the 4.2% dwindle seems like an adjustment to the book closure that was on the 24th. And now to the JC1, NMG. The closure for their buyback program was on the 24th. The group reported an 82.5% success rate on the back of 17.1 million repurchased shares against the selling of 20.7 million shares. Looking back, the group accounts for about 96% of the traded shares between 28th June and the 24th of September. The volumes over the buyback period reflect some sort of disposition effect, which given the price levels during the buyback period, which are not so enticing for shareholders who bought at high double digits or even triple digits, as seen in the 5-year price performance in the chart. And now that the single buyer demand is out of the market following the closure of the buyback program, it's a no-brainer that the near-term price behavior will be dictated by the adjustments in the buyer-seller dynamics. As another side note, disposition effect is a behavioral finance theory by two gentlemen, that's Sheffin and Statman, I believe, that demystifies the psychological bias investors are exposed to when dealing with winners and losers in their portfolio. It points to the tendency of investors being reluctant to dispose of assets that have lost value and prematurely sell off assets that are making gains. Later on, two other gentlemen link this bias to how we choose between alternatives that have different risks and uncertainty in a theory that's widely known as the prospective theory. In a few words, it paints a picture of how investors value gains and losses differently. Trading well, acting immediately on qualified steps, and realizing that the only thing worse than being wrong is staying wrong comes in handy when dealing with such psychological biases when investing. But that's neither here nor there. And looking at the foreign participation, foreign investors exerted their dominance in the bourse, accounting for 58% of the week's turnover. They exited across key stocks to clock net outflows of 419.3 million. Unga Group released their FY21 results on Wednesday. Earnings per share was reported at 2 shillings and 39 cents, edging up 431% year-on-year from 45 cents in 2020. Revenues grew 1.4% year-on-year to 17.8 billion, with finance costs coming in at 150.6 million. That was a 24.8% year-on-year decline. Operating profit for the period came in at 616.2 million, translating to 585 million earnings before tax, with finance costs coming in at 19.6 million. As an observation, operating profits were impacted by reduced margins and finance costs. That said, a salient headwind was the rise in international wheat prices on the back of poor harvest and adverse financial measures imposed by some of the leading exporters some of the leading exporting economies. With this depreciation of the Kenya shillings against the dollar also impacted the importation cost, leading to substantial FX losses. Moving on, total comprehensive income grew northwards of 300% to 293.5 million on account of a 601% year-on-year growth in earnings from continued operations. The group's balance sheet shrunk 16.6% year-on-year to 10 billion, and it closed the period at a cash-rich position of 1.5 billion. Management maintains a bullish outlook on the zero rating of flour cushion consumers against price inflation, though the aforementioned high cost of raw materials is a near-term concern. Group reported a decline in its earnings per share from 3 shillings and 77 cents in first half 2020 to 10 cents. The decline was on account of the one-off gains from discontinued operation on the sale of the counter businesses in 2020. Top line grew 1.7% year-on-year, with net sales coming in at 1.1 billion. Operating profits closed the period at 8.5 million on the back of lower staff costs. Provision for bad debts declined 92.3% year-on-year, and interest income rose by 153.9% year-on-year to 25.4 million and 99.2 million respectively. Profit after tax from continued operation came in at 31.4 million on a 51.1 million tax charge on profits before tax of 82.5 million. The comprehensive income for the period came in at 39.3 million, 97.3% year-on-year decline on account of the aforementioned one-off gain from the counter businesses. The counter's balance sheet shrunk 31.7% year-on-year to 8.8 billion, and it closed the period at a cash-rich position of 3.2 billion. Looking at the outlook, the board of Scan Group gave a profit warning as we saw earlier for the current financial year, based on a preliminary assessment of its projections of the consolidated financials. The reason for the expected lower earnings is due to the discontinued operation in 2020. Looking at the sub-Saharan market performance, the Nairobi All Share Index outperformed its peers on a week-on-week median comparison. The market's price to earnings ratio was above the African median multiple of 10, while its dividend yield was below the African median by 210 basis points. On the corporate calendar, we have Centum's 33 cents first and final dividend with a book closure of 8th October. To you, Melanie.
Thank you, Wesley, for taking us through the equity segment. So for now, I'll just be looking at the financial highlights of the week. So financial sector highlights for the week. So the banking counters were relatively stable with the exception of NCBA that witnessed a 5.1% dip week on week to 26 shillings. Coop Bank rose marginally by the end of the week to close at 13.4. That's 1.1% weekly rise. So looking at the insurance counters, CIC and Liberty recorded a rise of 5% to 2.96 and 4.6% week on week to 8.12 respectively, reversing the weakening trend that they had the week prior. So for Jubilee and Sanlam, on the other hand, they reversed their gains. So it's like counters were switching their positions. The previous week, it closed at 350 shillings, which was a 5% decline week on week. And Sanlam at 11.5 shillings, that's a 3.4% week on week decline. So looking at maybe it could be that the reason that NCBA saw a dip was because of the Fitch ratings that gave NCBA Group a B+ rating with an outlook of negative. So they based this rating on, so the negative outlook on both NCBA Bank and NCBA Group, they mirror the negative outlook on Kenya's long-term debt. And this is because the bank has a significant sovereign exposure. That means it has significant government loans in their books. And that makes NCBA's credit profile very sensitive to adverse changes in the sovereign credit profile. So the NCBA Group is expected to remain profitable, and as is seen with the commendable results, but the performance may be under pressure due to high provisioning if the asset quality continues to go down. So pre-impairment profitability, that's the profit it gets before considering loan provisions, is quite healthy, although the net interest margin has been weaker due to a higher cost of funding. And also, if you look at the books, actually last time they had a contraction in the loan book. And they say this is mostly because companies were not investing during the time of COVID, but they're expecting to pick up. So they say that the balance sheet is quite healthy and has relative strength. However, the group is mainly looking at reliance on more expensive institutional term deposits. And also they pointed out the group's NPL ratio at 16.2% is much higher than the 2020 figure of 11.1%. And so this ratings agency anticipates further pressure on the loan book. So looking at some of the competitive advantages of NCBA, it's the growth of its digital banking, especially due to M-Shwari and Fuliza. In a prior interview, the group MD had noted that the M-Shwari is reaching its plateau at 26 million customers, so they're trying to find ways to be creative around that service. For Fuliza, on the other hand, there's still room for growth, and that's why the growth has been mostly on the digital loans has been mostly coming from Fuliza. So they're also looking to grow their own mobile lending platform, that's the NCBA SASA, for its bank customers and to make it more available. So recently, Safaricom had released a sustainability report, and it showed that Kenyans borrowed 351 billion using Fuliza in the financial year 2020-2021. That's a 43% year rise from 245 billion before. So we can see the type of growth trajectory Fuliza has. M-Shwari, on the other hand, lent only 94 billion, a 27% drop from 129.6. So we can see this is why the group MD was saying that M-Shwari seems to have gotten to its plateau. So just looking at NCBA strategy, they plan to roll out the technology in its mobile savings and loans business in Uganda, Rwanda, Tanzania, and Ivory Coast this year. So this is expected to boost non-funded revenue as well as boost cost efficiencies. We also saw that they've been expanding their branches and rolling out innovative digital products, and also looking more into the corporate finance and asset finance segments. So the next piece of news was that the mobile money agent transactions have hit 4.4 trillion this year. This is a 44.7% rise from the previous in 2020, just going to show that there's continued recovery for individuals and businesses, as well as now schools reopening and just seeing generally an increase in demands of goods and services. The number of mobile money agents to 304,808. And the governor noted in a speech that actually 96% of transactions are now happening outside the bank, with 85% now being done on mobile phones. So we saw that because of this now, we're seeing that digitization is breeding a new generation of services now where the digital lending apps are coming in, and the CBK has come in to propose to regulate, to license and regulate these providers, because we saw how people have been complaining about some providers like listing people on the CRB listing and also using the information without their consent. So the CBK is looking on how to regulate this. We've seen also some banks now are closing down their branches because of the shift from brick and mortar to digital platforms. Just last week, SBM Bank, they consolidated 3 branches and 2 express units, just to highlight that customers have been moving more to the alternative channels. Lastly, there's a CBK update on the loan restructuring book. So during the MPC meeting, Dr. Jeroge gave an update on the loan book. So about 15% was restructured as at the end of August, which presents about 435 billion. So 93% of this book is performing, but the other 7% is the one which is at risk, which is about 30.4 billion. So credit risk is still there. It still remains elevated, as we've seen that the NPL ratio, non-performing loans ratio, is at 13.9%. Though it's been coming down, it's still higher than the pre-pandemic levels. So there's still some way to go. Just a reminder that some banks have actually been giving their customers, accommodating their clients, like KCB had said they'd allow for further restructuring for its most distressed clients for about a year. For Stanbic, they said they're going to accommodate clients on a case-to-case basis. So we're going to see banks just try to figure out how to work with their clients to get them to pay these distressed loans. And so just going to the next slide, the idea of the week. So we still maintain a long-term buy on Kenya Re, mainly because it's a deeply discounted stock. It's a price to book ratio of 0.2 versus a median of 0.83. And also the fact that Kenya Re is a national insurer, it receives compulsory seeding from insurers in Kenya. So that gives it a consistent source of revenue, and its balance sheet is well capitalized. Given that it has significant government shareholding also, there's an aspect of digital dividend play that comes into effect for income-oriented investors. So yes, I think I can end it at that.
Thank you very much, Melody and Wesley, for the thoughtful. Yes? Can you hear?
No.
Yes, I can hear you, Melody.
Oh, okay. Thanks.
Yeah, I was saying thank you very much, Wesley and Melody, for the presentation today. And I think we get now to the Q&A section. If you have any question, you can kindly just shoot it up on the Q&A section or in the chat section, and it will be answered live by the team. So Kamau is asking 3 questions. One is Kenya Power is a crucial monopoly, but could it go down in the way of Mumia's Uchumi and be impossible to resurrect?
So for Kenya Power, it's let's just say it's just a wait and see, because now there's those the restructuring proposals that were given by the IMF for how they're going to manage their debt and just generally getting their books in order. So I would say that it's a bit early to tell if it would go down. Let's wait and see how the reforms come about, as well as we've seen that the task force led by John Gumi, the recommendations that they've given. So basically, they say that they're going to look at the avenues of leakage, like where people are diverting the electricity, that's theft, things to do with procurement, and also the fact that they want to renegotiate the purchasing power agreements. But an aspect of this is what legal cost would it have to get out of these agreements? So I think there are many factors to look at before considering it going down, in my opinion. But if things are not corrected as it stands right now, it stands the risk of going down. But we've seen that some initiatives are being put in place to make sure that things pick up again. That, in my opinion, is what I think at the moment.
So, given that it's operating on a negative working capital, which is against the listing rules, should a shareholder dispose the shares or wait for the ongoing restructuring?
That's a big question. In my opinion, generally, I would say we wait and see what the reforms are going to kick up in the company. Because it's a monopoly, we anticipate that they have some certain type of advantage there. Though now the issue of that, the private purchasing agreements, as I said, how they're going to come around that, and also generally how they're going to fix their procurement issues, the corruption issues that have been highlighted. And I think it can come back with the correct support and the correct strategy. But as of right now, it's a bit too early to tell, in my opinion. So investors can just wait a bit and see how things go.
Okay, the third question is, why are shares of Cooperative Bank stagnant despite positive results?
I would say, in my opinion, that Cooperative Bank has taken a bit of a conservative stance as compared to other banks like KCB, Equity. You've seen how they've been venturing into markets like DRC and Rwanda. So it could be that investors view that maybe the strategy is not as aggressive as these other top-tier lenders. Also, we've seen that they have been quite, let's say that their provisioning is quite elevated. They have a different, it's elevated compared to KCB and Equity, which have been reducing their provisions over time. But I suppose every company has its own strategy on how it's going to deal with its credit risk and its provisioning policy as well. But for Coop Bank, we've seen they have this MCOP cash that is based on its salary checkoff. So there's as if they mentioned that it has low credit risk and it has a good yield of about 8%. So they do have pockets of opportunities, like after they acquired Kingdom Bank. Now the bank has now even gone back to profit-making territory, and it's giving them access to the asset finance business that this bank does. So even though it's not expanding aggressively to other markets, it has its own strategy that it's coming up with. Even the Project Kilele strategy that it has, and the Soaring Eagle. So it has ways it's looking on how to manage its credits and its loan book.
Okay, as we wait for participants to maybe ask us another question, I had a question on myself, like rather myself, not myself, on myself here. We saw the way power was being priced in KPLC, how it buys power from KenGen vis-a-vis the IPPs. Could that have an effect on KenGen's books, given that it's almost it sells power at the cheapest price as compared to the IPPs?
I suppose if they're able to renegotiate these contracts, you can see, because only such a small number of IPPs are the ones that have the greatest cost. So if they're able to renegotiate these costs and get power at a lower price, we can see this cost benefit being transferred to the consumers. So for me, I think if they can be able to renegotiate, because it looks like Kenyans are paying for power that we actually don't use. So that's a loss in itself. Yeah.
Okay. There being no other question, I don't know, Wesley, do you have any closing remarks?
Well, Melody has painted the picture with very vivid details, but just some 5 golden rules I love so much. They say the first is trade to trade well, not just to make money. This keeps you from some psychological biases like the decision fatigue, disposition effect, hindsight bias, heuristic simplification, and the narrative fallacy. Then rule number 2 is protect your capital. Rule number 3 says act immediately without hesitation on qualified steps. Rule 4 says the only thing worse than being wrong is staying wrong. Then my favorite, rule 5, says if confused, remember rule number 2, which says protect your capital.
That is very insightful. Melody, any closing remarks?
I can't hear you.
Any closing remarks, Melody? Can you hear me now?
Oh, yes. Sorry, yes.
Yeah, I was asking any closing remarks before as we close. Yeah.
I think just thank you and wishing the investors a lovely week ahead, and they enjoy the holiday that's coming up. Mashujaa Day, yes? It's Mashujaa Day, yes?
It's Huduma Day first.
Oh, Huduma. Oh, my goodness. Sorry about that. Yes, that they enjoy the holiday that's coming up ahead.
Okay, thank you very much, Melody and Wesley. So as an investor, remember, or rather one other thing maybe you can add is that you don't lose until you sell. So when you see the counter that you've invested on going, the share price going down, I think waiting is, or rather waiting for it maybe the wait might be long, but you don't lose until you sell. So you can buy shares and sell them via our application called Jikuze, which is available both on Apple App Store and Google Play Store. And while at it, you can also invest in our money market fund, that is Helaimara. And to register, you can just download the application and start investing today. So thank you very much for setting apart this time to attend this webinar, and we look forward to seeing you next week. Thank you very much, and bye-bye.
Thank you. Have a good week ahead.